China's property market is in crisis. Goldman Sachs reveals the impact it could have on economies down under.
The adjustment underway in China is a big deal. The Aussie dollar and the Kiwi dollar are both very low. The single largest channel through which China impacts Australia is through the iron ore market, by some margin.
It's Friday, the 8th of September, and you're watching Markets with Madison. China's property downturn comes with credit risk, and the fallout could be felt in Australia and New Zealand's economies. That's the view of Goldman Sachs researchers, as huge property developers file for bankruptcy and risk defaulting on debt payments. Property prices in China are down between 10 and 20% in some major cities, and sales are down 30% from their peak. That's causing concern over Chinese property developers, who Goldman Sachs says rely on forward sales for their financing. To see evidence of the downturn, look no further than Country Garden, once the largest developer in China. It missed some of its bond payments last month. It did make the debt payments within the grace period this week, cooling concerns, but barely helping its market value. It was once worth 13 Hong Kong dollars a share. It's now priced around 1. It made a record net loss of $6.7 billion in the first half of this year. Another, Evergrande, is also deep in the red. Its shares have been in free fall since an 18-month trading halt on them was lifted. It's desperately trying to restructure its offshore debt obligations, leading it to file for bankruptcy protection in the US a few weeks ago. According to Goldman Research, the total debt in China's property sector totaled 58 trillion renminbi at the end of last year. That's $8.4 trillion and 48% of China's GDP. The debt has been ballooning for the past decade, peaking in 2020, before deleveraging as the government introduced tougher rules on borrowing called the 3 red lines. 2/3 of the debt is held in mortgages, the other third by developers. Goldman believes the biggest credit risk is within that developer debt, most of which is held by banks. It estimates some credit loss is likely, but the bigger banks could easily absorb it. But it's causing a crisis in confidence and adding to fears about China's economic growth, particularly if construction slows down markedly. Australia and New Zealand rely on trade with the Eastern superpower, so anything that impacts its mainland will eventually be felt here. Goldman's chief economist down under, Andrew Boak, is across the risks, among many others, which we'll talk about too. Hey, Andrew.
Morning, Maddie. Great to be on the show.
How do you foresee this property downturn in China potentially impacting New Zealand and Australia's economies?
Look, the first observation I would make is that the adjustment underway in China is a big deal. We've estimated that, or the Goldman's team has estimated that, the property market in China and property-related activities account for roughly 30% of the Chinese economy. And over the past few decades have added 2 to 3 percentage points to Chinese GDP growth each year. So, China is losing a major growth driver as we move forward, and it navigates the overbuild and the debt overhang in the property sector, and on the demand side actually as well, sort of a generational step change lower in demand via slowing population growth. So look, Australia and New Zealand very much in focus, given that we export about 6 to 7% of GDP worth of, whether it's dairy or iron ore, hard, soft commodities, a whole bunch of stuff over there. So Australia and New Zealand very much in focus. You can see that in currency markets, the Aussie and the Kiwi very depressed. So this is something we're concerned about. And in particular, I would say probably the key pressure point really in the New Zealand economy is the agricultural sector, in particular the dairy sector, and recent downgrades to Fonterra's milk price estimates for the current or the coming financial year speak to a significant negative income shock for the New Zealand economy at a time when it's already struggling with significant rises in cost of living, interest rates, depressed consumer confidence. So we do worry about what that means for spending and investment around these rural areas in New Zealand.
If there is specifically credit loss in China on that developer debt piece, how could that risk spread through Australia and New Zealand? How exposed are we to that potential problem?
I think the story is a little bit more nuanced, and I think the multipliers of the Chinese economy to the Australian economy far lower than they have been in prior cycles, and that's for a number of reasons. I mean, firstly, let me say the key channel, the single largest channel through which China impacts Australia is through the iron ore market by some margin. And when we look at that market, iron ore prices this morning are $115 a tonne. Now, they're remarkably resilient, and they're well above the break-even level cost of production for Australian producers, and they're well above the number that the Commonwealth Treasurer uses to calibrate the public finances. They're in fact, the spot prices are in fact double both those numbers. So iron ore prices would have to fall 50, 60% before you see a fall in Australian production and exports of iron ore, or some sort of cutting of government spending, which would really cascade through the economy, or tax increases or something like that. Now, the other factor, of course, is that it's different to, say, the 2014 period, where we saw a big fall in iron ore prices, undermine growth in the Australian economy, is that we don't have high levels of investment in that sector. We haven't had actually for several years. We're not seeing a lot of expansion. So it's not like business investment can fall a whole lot from here, courtesy of the iron ore price falling, 10, 20% even. So I think the story around the iron ore market is far less negative perhaps than is widely understood. And then similarly, when you look at the multipliers from, say, Chinese tourists coming to Australia and New Zealand, COVID basically saw none of them come, and we're still coming off very, very low levels. So it's not like that can fall a lot from here. The students seem to be coming back. The Aussie dollar and the Kiwi dollar are both very low. Now, makes our holidays overseas more expensive, but it also makes life a lot easier for import competing and export orientated businesses. So, it amounts to an easing in financial conditions.
Okay, let's assume that China doesn't take any further action to shore up its economy. This week, the RBA cited China's deterioration as a risk. How could this play out for rates in both yours and our economy here?
Just to take a step back, a deteriorating economy in China that results in weaker growth and inflation outcomes, perhaps in Australia. I mean, that would work in favour of rates being lower for longer, I would say, rather than higher for longer. That's sort of the way I would be thinking about it, and I think that that's likely the way the RBA is thinking about it at the moment as well. It's sort of it's a period of assessment. They're worried about low levels of consumer confidence. They're worried about not fully understanding the lagged impacts of monetary policy. And although on the global front, the US economy looks on a far firmer footing than it has done for some time, same can't be said for our major trading partner, China. So that probably adds to the case. Let's just sit on the sideline and wait for a little while longer. I'm not. I think the RBA is right to be very focused on it. I think at the margin, it definitely adds to the case that perhaps this tightening cycle is complete. No more rate hikes from here. It works in that favour for sure. But I don't embrace the doomsday scenarios about what the developments in China mean for the Australian and New Zealand economy. I think that it's a far more nuanced story, and I'm actually a bit more of a balanced view and a bit more constructive on the sort of medium-term outlook.
What data do you think is key to watch out of China from here?
Yeah, well, look, the data that I've been watching very closely recently is the manufacturing PMIs, and the NBS manufacturing PMI in China has actually improved sequentially over the past 3 months. Now, I'm not saying it's early doors, right? So I'm not saying China's out of the woods by any stretch, and I think growth's likely to remain quite weak. So, but if there is some stabilisation in the manufacturing sector in China, that's kind of a big deal. So, sort of watching that. That's fairly timely, high-frequency data. It would be great to see, some sort of shock higher in consumer confidence or business sentiment in China. I'm not that confident that we'll see that, but obviously we'll be watching that data closely as well. So yeah, I think the PMI numbers are key, alongside the usual sort of monthly data on industrial production and retail sales and those sentiment surveys.
How much weight do you actually place on the data that comes out of the Statistics Bureau in China? Do you feel like you can trust it?
Yeah, I mean, there are limits to data, in all countries, and as you know, China's no longer publishing some data on aspects of its labour market, which is not ideal. But as we do with lots of different countries, we we use the official data sources, but we also create our own proprietary measures using high frequency signals from a range of different. It might be aircraft kilometres travelled. It might be trucking distances. It might be foot traffic at malls, and we can create these proprietary indicators of activity that give us a bit of a cross-check to the official numbers, including in China. And we're actually, our Chinese economics team is actually updating some of those numbers right at the moment. So stay tuned. There'll be, I think, quite an interesting update on how we think about that and cross-check the official statistics.
Obviously, as you've mentioned, China's economy is a vulnerability for both of our economies, and New Zealand more so, given our agriculture sector exposure. What are the potential other vulnerabilities that you think our economies could face over the next, say, 6 to 12 months? Is there perhaps something more pressing than China?
Yeah, so as you say, China's probably the key external one. Domestically, look, if we'd had this conversation 6 months ago, it would have been an easy answer. I would have said the housing market. Because in Australia and New Zealand, house prices were falling double-digit rates not that long ago, and we were actually quite worried about, whether that would become a disorderly adjustment, and we're worried about the negative wealth effects from that. Now, fast forward to today, house prices in Australia have actually been rising at double-digit rates for a number of months, and in New Zealand, it also looks like we're at a positive inflection point. So the key vulnerability now, I think, the focus more is on debt servicing. The focus is more on, do we fully understand and appreciate the lagged impact of the tightening done to date? In Australia in particular, given we have an unusually high share of mortgagees who have borrowed on 2 to 3 fixed rate mortgages some time ago, and they're resetting at much higher rates over the coming months, and we're sort of moving through that sort of key reset period right at the moment. So yeah, it's cost of living pressures, it's rising interest rates, it's the way that high inflation is crimping household disposable incomes, and the read-through of that to consumer spending, which both in New Zealand is particularly weak. Our sense is that it keeps growth low and weak and subtrend for an extended period. But again, I think I don't embrace the doomsday scenarios. There are a number of reasons why I think we can sort of manage through the next few months, and things can feel a lot better next year.
What are our strengths that give you your optimism, Andrew?
Well, I think there are a lot of parallels between the two economies, but there's reasons for optimism when we look at say that the excess savings that have accumulated through the COVID years in both economies, again, particularly in Australia. That's an important backstop to growth and backstop to the economy. And even though interest rates have risen a lot, when we look at the big banks and the asset quality on their balance sheets, it's actually still very high, even for borrowers resetting to much higher rates. That's a good news story. So excess savings. I think demographics. China's got a problem on big headwind on the demographic side of things. We've actually got the reverse. We've got and have long had young, well-educated populations in a strong migration-led population growth. Some of the fastest in the developed world. Mechanically, it's quite hard for your economy to go backwards if you're bringing in 1.5%, 2% of the population, all these consumers coming in each year. So I think that's a strength. The labour markets are obviously strong. Unemployment rates 3.5%, 4%. People can get jobs. Wages are rising. Hopefully, moving forward, inflation falls, so real wages should start to improve as well. And then I think if things really, if you're really worried about a downside scenario and things go horribly wrong, I think that both Australia and New Zealand policymakers, there's some room to move there on both the fiscal policy and the monetary policy front to sort of backstop the economies from the worst case scenarios. So look, there are a few pressure points there. There's reason to be sort of cautious about the outlook, but I think overall we think we can navigate through this key risk period. And we remain constructive on the outlook. And if we look at the US, for example, I think that's a good example, because the US generally has been 6 to 12 months more advanced in a lot of macro trends vis-a-vis Australia and New Zealand. Certainly the COVID reopening, and a year ago it was a strong consensus view the US economy would not only enter a recession but was likely already in one. Fast forward to today. Things have turned out a lot better than anyone expected, and perhaps we're going to follow that path as well. I wouldn't rule it out.
Thanks so much for your time. I really appreciate it.
Great. Thanks, Madison.
I want to know how you're assessing these risks coming out of China. Are you as optimistic about it as Andrew, or do you think otherwise? Let me know. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.